top pick number one, MDA, the satellite player.
Yeah, this one's been fun to investigate. There's been a lot of changes that have been happening in the satellite industry. Some that we probably realized a little bit late, but we still don't think it's too late to get into a name like MDA. And one of those key things that costs have come down so dramatically in the space to launch satellites into space. And you have these lower Earth orbit satellites that are now going up at a pretty rapid clip. And MDA is one of the main players in this space. They're a pure play space player, and you can get this stock at a very cheap multiple given the amount of growth that we expect is coming from this space. So now you have communications providers that are putting satellites up in the air. You have other network companies. You have companies that are doing still the traditional work on observing Earth. And then who knows what happens down the road. But what we really like about MDA is they're laying the seeds here to be able to deliver on this, what we also expect is a significantly growing market down the road. And there's some estimates that this is a $400 billion market right now that's going to grow to $1 trillion. Some say it's going to grow to much higher than $1 trillion, but MDA is going to have the capacity to be able to manufacture these satellites, get them in the air efficiently, and continue to win business that way. And so we like stories where you have this nice CapEx cycle, that CapEx goes into building out this capacity. And then as it comes out, you're getting all these orders in this backlog, which they have about $3 billion in backlog. And so when that comes in and you've spent all your CapEx, it starts to come through as free cash flow. And given that the costs are much more manageable than they've been in the past, we think that cash flow can be quite significant for quite some time. So, catalysts here are going to be winning new satellites awards, new constellations, which we expect to come. They've got a bid pipeline of like 17 billion, they say, or some have said, and also getting some of these recent awards in the air without any big hiccups. And then third is going to be free cash flow generation next year. So we like MDA as a top pick here.
Microsoft is your next idea.
Yes, I know it's Microsoft. Everybody knows about Microsoft, but we just went through a whole process of really digging into this particular company and how much are they going to benefit from this whole AI transformation that we're seeing happening in the world. And when you have 400 million users of their products, the network effects of that are just massive. When you look at Azure, which they have, we think revenue there is going to double. So that's going to be just a massive business for them in 5 years from now.
Their cloud business.
And that's going to, it's going to overshadow the rest of the business, which is actually still a pretty good business. So when we look at the multiple that it's trading at, about 30 times PE, we're like, you know what? This is actually more like a market multiple when you bake in all of this growth that we're going to get for all these other businesses. So, rarely is there a company that has this wide of a moat with this large of an addressable market. And so it's one that you have to own. You want to own it, and you want to hold on to it for quite some time. And if there's ever a pullback in U.S. tech stocks, I think it's one that you should have at the top of your list to buy. It's not going to have the same kind of issues as some of these semiconductor plays that are just more pure right into, there's a big supply-demand imbalance, whereas there's such a stability that comes with Microsoft that we want to own that for our clients for quite some time.
And then finally, you got a natural gas idea for us, one of the country's biggest producers, ARC.
Yeah. I've heard you talk a lot about ARC. So, we went through ARC quite a bit, trying to get some exposure to this commodity play that we're seeing unfold. Sorry, I should say this, these inflationary pressures that we're seeing in the short term. It's interesting if you look at the energy complex from a stock perspective. They're up about 16% in the last 3 months versus tech stocks up about 4 or 5%. So we are seeing those pressures start to build again, and so we wanted to get some exposure there to protect our client portfolios from inflation. And this was one that we thought, ARC was one that we thought would be a really interesting addition to client portfolios. Everybody owns Tourmaline. I think a lot of people own ARC as well, but from a growth perspective, they're not looking to do big acquisitions. They're not looking to divest things. They own all of their own properties and infrastructure, which we really like because that's where we've run into problems in the past when we invest in an E&P player. They have a big liquids division that's going to generate some nice margins for them, and they have a lot of choice of what they're producing. So from a free cash flow perspective and from a realized price perspective, we think ARC is at the top of the list. And I guess the third thing I'd say, or maybe the 10th thing, I don't know, I've been rambling on about ARC, but is that they have all this exposure to international pricing as well down the road. So they've been really at the forefront of locking in a lot of LNG contracts. And so making sure that they secure that capacity. So when we get the Trans Mountain pipeline up and running, we're going to be sending gas out that way, and they're going to be realizing much higher margins as well.
Does that carry gas, the Trans Mountain pipeline? I didn't know that.
Well, liquids and all the
liquids.
So they're going to be tapping into the LNG in a big way, more than we've seen a lot of other companies tapping into that. So
sure.
This is going to be positive for them from a realized price perspective.
Right. Yeah, it's interesting. Given the weakness in U.S. Henry Hub prices, ARC has done very well, and people are buying into your thesis there.
Well, yeah, and you look at the prices they've actually recognized over the years. It's been much higher than what the actual, Henry Hub or the AECO price has been. So that's encouraging, and that to us is a sign of a great management team with great assets and a lot of optionality. So if you could pick a name that you want to hold for a long term, C&Q's up there on our list, ARC's on there, and Tourmaline's on our list. And this is just one that we've been recently adding to. So if these geopolitical pressures continue to abate, which we hope they do, you might see some pressure on the oil price or on natural gas prices, which might provide an opportunity to reload on this name if you've lightened up on energy over the last year and a half.
First idea, Cenovus Energy.
Yeah, Cenovus is a $53 billion company, and it's an integrated energy company. So that means that they operate in the upstream, which is obviously the exploration production, the midstream, which is the pipelines and some of the storage, and then also the downstream, so they do refining. We always look to optimize portfolios and look to invest in, we sort of have our asset allocation and our sector allocation, and within the sector allocation, we try to optimize to the best equities that we can find. And Cenovus came under some pressure last year because of some refining assets that they had that needed some investment. The company very swiftly invested in those assets and debottlenecked and got them back up to back closer to capacity. So that issue is behind them, but it created an issue where Cenovus was trading at quite a discount to the integrated peers, including Suncor. So we made the switch, and that has tightened up quite a bit. That valuation discrepancy has tightened up quite a bit. So that part of the story is kind of played out. But what they do have as well is a lot of leverage to differentials. So that's the difference between the Canadian barrel of oil selling price versus the U.S. barrel of oil selling price. And that's come down as the TMX expansion has come online. And we hear that it's going to be filled up by imminently. Yep. And so they'll be starting to run that thing at 890,000 barrels soon enough. And that alleviates a lot of this egress problem that Canada has. And it creates an opportunity for Cenovus. They have a lot of leverage to that. And
isn't it bad for them, though, because their refineries won't be able to capture the...
Somewhat, but the good offsets. So the fact that they can sell their production at a higher price offsets that. And for them, it's if you can think about it, every $5 that differential compresses is about a 6% bump to their free cash flow profile. So it's quite good for them. So, and the other thing is that they are in a deleveraging process. They're taking their debt down, and they're going to meet a hurdle, we think, in the middle of this year that's going to cause them to shift their priority for free cash flow from debt repayment to the unit hold, to the shareholders. So that means that we're going to get dividend bump, might even get a special, and we're going to get share repurchases, all accretive to the shareholder.
Your next idea, Chartwell Retirement Residences. Demographics on your side here.
Yeah, I think we very recently made the shift from multifamily into retirement, and that was really predicated on the fact that immigration has run really hot, really high for a long period of time. Governments are rethinking their policy because they've got to do a little bit of catch up on infrastructure building and services, which have been really bogged down by the new entrants that are coming into Canada. So we've shifted from that theme, that investment theme, over to retirement homes. There's a demographic. Canadians are getting older, and they're going to need homes. There's a lack of supply. This is an unregulated market, so rental rates can increase. The thing I liked about Chartwell is it's all senior homes, so no long-term care or very little long-term care. The nice thing is that they've got some vacancies. So they're sitting around 86% occupancy. We think they're going to get closer to 90% by the end of this year, and then through 90 into next year. That creates organic growth and more cash flow for the company. And we like the demographic theme.
Okay, and then finally, Granite REIT. They're one of these REITs that specializes in warehouses.
Yeah, it's sort of an e-commerce play. That's the theme. It's $7.5 billion enterprise value. This is the old Magna holding company, real estate holding company. So originally, when it went public, it was pretty much predominantly, maybe even 100% Magna assets. That's come down significantly, but they become a very large, kind of Canadian-centered, real estate company in the industrial space, and we've held this for a long period of time. We really like management. Love the fact that half their assets are in the U.S., but then they've got somewhere around 15-20% in Canada, and then they've got exposure to Europe. So they can really deploy capital when they're investing. They can deploy capital into any one of those markets, and they can also harvest when they're doing capital recycling. If they want to sell a non-core asset, they can look at where valuations are in the different markets, and they can be really quite nimble in that respect. So we really like it. Clean balance sheet. So if amongst its peers, it's probably got the best looking balance sheet. So that means if interest rates do stay higher for longer, these guys are not as affected as the rest of the group. So like it for a number of reasons and held it for a long time.
You said you were lightening up on multifamily REITs.
Yeah, we don't own a lot of REITs right now, and it lumps into that intersensitive group. So we've scaled back at the beginning of 22 when we were just at the precipice of interest rates rising. We went from north of 20% real estate to south of 5% real estate. So we're down to kind of two names. And we've been dabbling a bit. We'd be about 7 to 9% right now. But yeah, the multifamily for us is really predicated on that immigration policy. And we think sentiment might drop a little bit for these types of investments just based on that immigration policy.
First idea is Bank of America.
Money Center Bank, the banks have reported largely for this quarter, and the results were not received that well, but the results were pretty good. As we talk about, expectation is something that you really have to pay a lot of attention to in the market, and I think they were led off by Jamie Dimon talking about J.P. Morgan's prospects, and Jamie has a way of wanting to pour cold water on any good idea or a good story, and you have to appreciate him wanting people to keep their feet on the ground, and I think he sort of set the stage for the bank earnings. And Bank of America came out with earnings. They beat on revenues. They beat on earnings. Their net interest income was fine, better than the street expected. Brian Moynihan, who runs Bank of America, was fairly positive about the consumer. Said higher interest rates would be a net positive for the company into the end of the year, but the stock still sold off. That said, it's going to have its time of the cycle. Will do very well, and that's why it's a top pick today. I think that it's a solid holding. Some concern about their bond portfolio being underwater. They have unrealized losses on their bond holdings of about $112 billion. But don't get scared off by the numbers. Of a very large bank, and they have ample liquidity to cover that. So that's not a concern. So we do like Bank of America. Next idea, Chevron. Yeah, Chevron. Well, this has been a holding of ours for about 6 or 9 months, and it hasn't done all that much. Of course, for the most part, 2023 was a negative year for energy. Yet, in the first quarter, energy was the strongest sector in the S&P 500, and perhaps it should have been. Energy prices are higher, oil prices are higher, partly on fundamentals, I think mostly on fundamentals, but also geopolitical tensions and some manipulation of supply by the known players. But Chevron is in a great position. It has a fortress balance sheet, only about 12% debt to total capital, Andy, and they pay out only about 44% of their earnings, yet their dividend is at around a 4% yield. So it's a great income stock. They've invested large amounts of money over the past decade to set themselves up for success, and that's exactly what they're reaping right now. They're in that
face-off with Amazon over who gets control of that Guyana oil field.
Yeah, and this is, you're always going to have these news stories. And earlier in the show, I was talking about not letting the noise affect the long-term thesis, and this would be an example. So they bought Hess. Street didn't really like it. Longer term, we think it's going to be a very constructive thing for them. But this is a company that is going to do very well. And as an aside, Berkshire Hathaway has a very large holding in Chevron, and they don't do anything lately.
Telecom, the vendor of telecom equipment, you like the look of this one?
Well, they're actually a company that lays fiber cable throughout North America. Okay. So when you have a company come into your neighborhood and they're digging trenches and laying cable, it could well be Dycom. 5 customers make up 66% of their revenues. So that means that if one of them makes a timing decision, you could have some lumpy results. Sure. Get used to that. If you're going to buy Dycom, it's going to be a lumpy stock, highly volatile. But the upward trajectory is to the up and to the right, and that's what we want as investors. They've got about a $6 billion backlog on the back of a $40 billion infrastructure bill that was passed a couple of years ago in the United States. $6 billion, to put it in context, is about 18 months of revenue for Dycom. So, and I was just reading this morning that by the end of the year, that's going to push over $7 billion of backlog. So this is a very good company, doesn't trade at an extreme multiple. Expect it to be somewhat lumpy because of the fact that short-term decisions can affect revenues and earnings. And also, when you're out there laying cable, if you have poor weather over a sector of the country, that can also affect you and push things off. But longer term, we believe Dycom is a strong hold.
All right, we're back on Market Call for the final segment. This is what everybody waits for, the top picks. Let's get to your first one, CGI. A tech play in Canada.
Yeah, it's a tech play. I think this is one, main thrust of CGI is they're an IT outsourcing and consulting company. And as more companies, look to offset cost pressures and digitize their business, CGI is a company that they turn to. So I think in terms of the business economics, there's wonderful demand drivers. It's, lovely business economics. It generates a lot of cash. And if you look at the valuation, CGI trading around 17 times earnings, very, very robust free cash flow yield at about 6%. And, a global growth platform. So this is one that I do really like.
Pulled back quite sharply recently. What's with the recent pressure?
The recent pressure is kind of the same is likely had to do with the Federal Reserve comments just about interest rates, right? Because you saw a lot of the higher growth names just kind of sharply pull back. So that's what when I talked earlier, like there are going to be pullbacks, and I think those are the times you want to wait and enter some of these names. You
alluded to this one earlier when we took a question on restaurant brands. That your preferred name was Yum China. Just elaborate a little bit more on what a Yum has maybe on its own or even relative to some of these other restaurant conglomerates. Yeah, like what Yum China, where Yum China really wins big versus everyone else is valuation. So if you look at its valuation, it's has a massive amount of cash on the balance sheet, no debt. It's trading about 14 times earnings. Very, very robust free cash flow yield. You compare that to even, its former parent, Yum China. It's 24 times earnings, 3% cash flow yield. So you got a valuation that's about half of its former parent that does have the same growth profile, and that's the negativity on China, right? Because there's a lot of negative sentiment on the Chinese economy and things like that. And so I think this is a business with a massive opportunity for growth and a very, very discounted valuation. So a really huge total return potential. So are those fears overblown as it relates to Yum China? Have they been dented? Has their sales been dented by a slowdown in China, or is this a play on a recovery? I don't know necessarily it's a play on a recovery. They were really hurt by COVID. Yes. And lockdowns and things like that, but they've come out of that flying. And because they have, they raised some money a few years back,
they took this opportunity to accelerate their store rollout. And so, there's a lot of negativity on China in terms of its property market. But if you look at, people in this population, they all have to eat, right? So I think this is a lower risk way to play a Chinese recovery in a company that has, all the like a debt-free balance sheet and capital loaded for growth. And I think this is one that you'll look back, 5 and 10 years from now has massive upside.
And that time horizon is important too, to understand where you're coming from. Your third pick is Brookfield Infrastructure Partners. What's the play there? What do you like?
This one is really. I always like to have one pick for income-oriented investors, right? Some people that are looking for income. And so this is one that has a wonderful dividend yield, a very, very good company with Brookfield as its sponsor. They, relative to, say, Enbridge or Fortis or some of the other pure play sector plays, they have a diversified platform. And it's also global. So I think in terms of a utility with, it probably has the best growth profile of any of these types of companies. So I think, you look at the valuation, 8 times funds from operation, that's, at the very, very low end of the range. Hopefully it can trade somewhere around 10 or 12 times, and it has massive opportunity for growth because you saw in all of this turmoil in the market, they're out acquiring.
Well, that's a good point. And there's so many different segments within this business. Yeah. One of them is data. Yeah. And I wonder, there's a conversation out there right now about whether some of these utilities can be growth names. Yeah. And in terms of all the data that's needed to run these AI models. Is Brookfield a beneficiary of that? Can you now look to some players in the utility sector for growth?
You can, and then I think there's few and far between, right? I think this one probably has the best growth. Why? Because they have access to capital, because they have multiple platforms, and because they're global. So, Brookfield is always a company, any entity that looks to be counter-cyclical, so you really like that. In terms of its data exposure, they're really big on towers and warehouses. Mm-hmm. And I think that's a platform they added 3 or 4 years ago. And again, bought assets out of bankruptcy and have continued to build those platforms out. So I think this is one that you can win on many fronts, and they can grow in a variety of areas that maybe some of the more localized firms can't.
Welcome back. Time now for top picks from our guest, Michael Higgs. He's taken your questions on U.S. and global stocks. Now we'll go to some of his top picks. Number 1 today, Kingfisher, KGF in London. Michael.
Yeah, Kingfisher is the Home Depot of Europe. They have brand names such as B&Q, Castorama, Brico Depot, to name a few. UK is their most important market, but France is also super important. This is a stock that's been under pressure for the last couple of years because of all the challenges in the UK with inflation, bad consumer sentiment. So it's really been an overhang on Kingfisher specifically. And when they look at Kingfisher over the last 5 years, they've had a real margin issue, especially in France. If you look prior to 2018, their margins were between 7 and 8% on the operating side, but they got crushed as they made mistakes in France on product assortment, inventory management, and numerous other things. So the margins got crushed almost to 0, 1 to 2%. So it's been a long road in terms of improvements. The management team has put in some new initiatives and spending a lot on the fulfillment side, electronic fulfillment, and basically logistics. And they're confident they can bring those margins back up to 5 or 7%, which we haven't seen in some time. So that'll be a huge relief if they can do that. When you look at France from a macroeconomic standpoint, the consumer sentiment there has been abysmal. It hasn't been this bad over there for the last 20 to 30 years. And their savings rates, which have historically been high at 14%, have gone up to about 18%. But we look over the next 1 to 2 years, we hope that gets alleviated by the rate cuts and better policies by the government, which would help consumers starting to spend again in France, and also by the same token in the UK as they reduce rates. So we're positive on Kingfisher. I would say that has a high yield. It's a 5% yield, which we think is intact. We put it in an income growth fund.
Okay. Kingfisher's number 1. Starbucks is number 2. SBUX, SBUX on the NASDAQ.
Yeah, a little no name, Starbucks. we've owned Starbucks for some time, but I think this is another entry point for people if you believe in the long term. This is a company who had a new CEO about 1.5 years ago. He put the pin in on the long-term algorithm for Starbucks, which was 5% comp store sales growth, 10% top line, which includes comp store sales, and a 15% EPS kind of growth rate long-term for Starbucks. Unfortunately, they've gone into a slower period right after he came out and put the pin in for that long-term algorithm, and the stock's been weak. In fact, I think the management team there has guided down for this next quarter to be probably below U.S. sales, to be below where guidance is. So we don't know where they're going to re-guide. And the biggest concern is with China. One of the biggest concerns is with China. They have 6,000 stores there. They only make about $3 billion. And when they say make, that's their revenue line. So they're probably not super profitable in China. And a lot of the analysts are actually attributing little to no value for their China business. And if you think they're going to guide down, so for the street, I think for a management team, it's probably better that they got that a long-term algorithm. It's probably better they tweak that down to 11, 12% EPS growth, because the expectations are already there, and that'll kind of clean the decks. So we'll see, I think, April 30th they report, and it could be a good entry point down to the $85 level before they make the changes they need, and the stock has a relief, and we get above $100 again.